Welcome to Retirement Optimizer's how-to videos to help you work through the program and plan your retirement. This video will work through steps 8 of the solver, assets. Step 8 requires input of assets that the retiree has or plans to have in the future. For example, real estate would be a typical appreciating asset that may or may not be disposed of during retirement. To add an asset, click on the Add Asset button and a table will appear. First, enter a descriptor of the extraordinary asset. Next, select if the asset is already owned. If the asset is not already owned, specify the year in the future in relation to the current year that the asset will be acquired. For this example, we will enter that the retiree already owns their house. Next, we enter the value of the asset. If the retiree already owns this asset, as in our first example, we will put the current value. In our next example, we will show the value entered, which is the expected cost at the time of future purchase. Note that the initial cost of the newly acquired assets will be automatically paid for from the monetary accounts, such as RRSPs or TFSAs, in the most tax-efficient manner. The spending target, or the target income, in the year of acquisition will not be modified. Next, we enter the expected annual growth rate while considering the inflation rate specified in our expenses. Note that a negative annual growth rate may also be entered. Then we must specify if the retiree plans to sell the asset during retirement. If yes, we must specify the number of years in the future that the asset will be sold. In this example, the retiree would like to downsize their house in 10 years' time. Note that the liquidation value and the liquidation value remaining are automatically calculated. These fields are a tool to assist in the even distribution of the value amongst the spouses, as well as the taxable and tax-free amounts. As this example is a primary residence, there is no additional taxation, where secondary property will incur a capital gains tax. So in this example, we must split the liquidation value amongst the spouses. Note that the solver requires all fields to be filled in, so enter a 0 value under fields that would otherwise remain blank. The liquidation value remaining will be automatically updated as we fill in the fields and can be used to ensure the total liquidation value is distributed. Another element to note, after distributing amounts, should you change a field that affects the liquidation value, the amounts will be proportionally updated automatically to match the new liquidation value. For example, let's say rather that the house will be sold 15 years into retirement. The liquidation value and the amount distributed between the spouses now update. However, remember that the automatic update will only occur if all the fields, including 0 amounts, are filled in. Now let's add a home equity line of credit. This is a reverse mortgage that diminishes the value of an asset. If a home equity line of credit is applied to the asset, you must specify the number of years in the future that it will be obtained. Or if in the past, enter a 1, which is the current year. Then enter the interest rate and the initial and annual amount of the line of credit, followed by the annual amount growth as a percentage. The amount owed, which is the amount of the asset that is not part of the estate value, will be automatically generated and the liquidation value will be automatically updated. By removing the line of credit, the liquidation value and the amounts distributed among the spouses automatically updates back. Let's work through an example of an asset that will be acquired in the future. For example, the retiree would like to sell their current home and purchase a smaller home. As the asset is not already owned, we must enter the year of purchase in relation to the current year. Next, we must enter the value of the asset at the time of purchase. Let's say the retiree would like to downsize from their current $1 million home to a home worth $700,000 in today's dollars. To assist us in calculating this value in 15 years' time, we can use the FV calculator. Start by clicking on the FV calculator button and a pop-up window will appear. Enter the initial amount, in this case $700,000. Then enter the expected annual inflation. Finish by entering the year in retirement in the future that you would like the value to be calculated. Once again, we can ignore the contributions table as this is to assist in step 7. We can copy the future value and close the window to paste the value into the appropriate field. We then enter the annual expected growth rate and select No, that the property will not be liquidated. We have finished our asset table, thus completing step 8 of the solver and can move on to step 9.